Well, I think that Trump will primarily focus on foreign policy issues from the executive to make policy decisions. And Harris will probably focus more on deploying executive agencies such as maybe the SEC or the FTC for certain antitrust or other regulatory actions.
Welcome to This is Digital, a podcast brought to you by West Monroe. Join us as we talk to leading experts about bringing the digital mindset to your organization.
Hi, everyone, and welcome to This is Digital, a podcast where we break down the latest digital trends and share tips on how you and your company can be digital. I'm Christina Galuzis, Director of Communications and Public Relations at West Monroe. I'm excited to be hosting another one of our Season 4 episodes, and today I'm recording at our Chicago office. In each season, we invite an economist to discuss an overview of the economy and provide their predictions. This season, we're thrilled to be hosting this episode in a presidential election year, which adds yet another dimension to the economy. This episode directly follows the Fed meeting on September 18th, and we will immediately discuss those events. By the end of this episode, you'll have expert insights from two economists on the current state of the economy with their predictions for 2025. We'll also discuss the impact of the Fed rate cuts, as well as the potential differences we could see between a Harris administration and a Trump administration. Let's dive in. Today, I am honored to introduce Matt Colyar and Justin Begley, both who are economists from Moody's Analytics. Matt primarily focuses on the labor market and monetary policy in the United States. Prior to Moody's, Matt worked with the World Bank, focusing on private sector development in South Asian countries and in the private industry as a financial analyst. Justin's work focuses on U.S. fiscal policy, geopolitical risk, and the U.S. labor market as well. He also develops models to forecast high-frequency data of the U.S. economy and is a frequent contributor to Economic View. Welcome to Matt and Justin. Thank you so much for being here.
Thanks for having us.
Yeah, thanks a lot.
All right. So the Fed outcomes are finally here. I think the anticipation was incredible among the business community and economists. And of course, the news is that they ratcheted down the rates by 50 basis points. So first question straight out of the gate here is, why do you think the Fed went with 50 basis points instead of a quarter point? And what does that difference mean for midsize and enterprise companies?
So the 50-point cut or 50 basis point cut, as opposed to the smaller quarter point cut, taking a step back there was a consensus understanding that cuts were coming. So this was the time to start easing policy. And what got us to that conclusion is inflation has receded considerably. It's not 2022 anymore. It's not 2023 anymore. Inflation rate in the United States and really across the globe has come down considerably. And that's given the Fed confidence to start easing policy. So that's the backdrop to where we were approaching September's FOMC meeting.
Right.
Now, when they announced that 50 basis point cut, what that says is they really aren't worried about inflation anymore. We agree with that, even if we did think they were going to opt for the smaller, more conservative step into the easing cycle. But by going with the half-point cut, what Chair Powell and the committee is saying is that they do not see inflation coming roaring back. There's really little evidence in the kind of underlying components, which we can get into, that would suggest that's going to happen. A little more cynical view would be they think they're catching up and they should have cut in July, and this is kind of a bit of a catch-up move. Chair Powell was asked about that in his press conference afterwards. He pushed back on that, expectedly, not to say, yeah, we messed up. Of course, he's going to, couch that in terms of, just being proactive. He said that the larger point cut, the half point cut was more signal of the FOMC's commitment not to fall behind. So I think he's splitting hairs there a little bit with some of the messaging that they have said and what they've done now. But largely, it's a story of the Fed not being concerned about inflation and thinking it's time to make policy a lot less restrictive. And so they started with a bang.
Yeah, and I'm curious to know then the difference between 25 and 50. It sounds like that's really helpful in understanding their reasoning. What do you think, though, it means moving forward for companies, especially in that midsize and large enterprise sector? How do you think it's going to impact their financial strategy? Do you think that the rate cut is providing more relief to industries and companies, perhaps from existing debt, or is it giving them incentive to invest? Is there more one of the or the other?
I think the existing debt, the debt refinancing story, is the more persuasive one. And even leading up to this meeting, again, we saw we foresaw a more cautious approach, but the more persuasive case as to why they should front load, why they should start quickly, getting policy back closer to their neutral rate fast is for that. I think an important reason would be that business refinancing. So the United States, this is for consumers, for businesses, have largely been rate insensitive over the past few years. It's, hey, what's going on? The Fed's made policy, lift interest rates dramatically. And yeah, things have slowed, but it's not 1981 or 1982. So there isn't this contracting economy that historical experience would suggest. And a lot of that is because of businesses and households locking in low fixed rates in 2020 and 2021. For households, we're talking about mortgages. That's 30 years. Those aren't coming due anytime soon. But for businesses, you're talking about 3, 4, 5-year debt issuance. And that stuff is starting to mature and need to be refinanced. So market rates are still higher than what was likely, what rate that debt was initially issued at in 2021. But by getting there quickly, you are minimizing, in a sense, how much more expensive that debt will be to be refinanced if you get there quickly. Of course, the Federal Reserve didn't say that explicitly, but I think it's a good argument. So for businesses, maybe refinancing is a little bit more palatable now than it maybe would have seemed 6 months ago as you're looking out at debt that's coming due in 2025 and 2026. So it's certainly it's got a bottom line effect on businesses that are not going to see as dramatic of an increase in interest expenses.
Let's shift to the labor market for a second, because I think that was, I would call it an unexpected part of this decision, right? I think everybody was so focused on inflation for a long time. And then the labor market just kind of came in as this and played this really big role in this decision. Would you agree that it played a big role in this decision, and how? Justin, do you want to take that one?
Sure. Yeah. I mean, I think through this latest inflation surge, because it's really the first one we've experienced since the 70s, there was almost kind of a sense in which people forgot that the Fed actually has a dual mandate. They have to maintain stable prices and maximum employment. But when inflation was hitting 9% in June of 22, the labor market was still growing at a healthy pace as it was still kind of returning to its pre-pandemic trend. The inflation became the main risk that the Fed had to turn its focus to. But when the unemployment rate over the course of about a year increased by, a little less than a full percentage point to 4.3%, now it's down to 4.2%, that brought the labor market back in view, because there's a certain sense in which the Fed, a lot of people expected that as the Fed raised interest rates, that it would have an effect on the labor market by, markedly increasing unemployment. And that's where the conversation about soft landing came in. Can the Fed reasonably raise interest rates to the extent that it does not drive up unemployment and just brings down the level of tightness in the labor market and bringing the supply and demand imbalance back into balance? Can it do that just by lowering the number of job openings and kind of that side of the labor demand equation? And largely, we found that the beverage curve, the kind of is the relationship between job openings and unemployment is largely kinked, and so we ended up getting this return to a more normal-like pattern where job openings could come down without a market increase in unemployment. But of course, when people saw that unemployment hit 4.3%, it really started making everyone feel a little bit nervous. So I think it did definitely play into the Fed's decision. I think maybe now that we have some more data, especially on more high frequency data on from jobless claims, we're seeing that those are trending down. So I think the concern of the labor market is a little bit overstated to an extent. But the Fed certainly does not want to see unemployment rise significantly higher, and so now it's seeing these balances between inflation and unemployment coming back into balance.
Yeah, Matt, do you agree with that? And what are maybe some other angles on the labor market that might be playing into this other than unemployment? And I think when we read into the labor market data too, we just see a lot of inconsistencies across industries, right? The white collar sector versus the blue collar sector, unionized versus non-unionized, sort of comment on that if you can, and how the economists and the Fed is looking at that.
My views are largely consistent with Justin that things are on solid ground, and I think Powell spoke to that as well. But what we're speaking about inconsistencies, and this is something that was mentioned yesterday at September's meeting, is the revisions that the QCEW, which we can spell out acronyms. It's quarterly census, but that might take too long. So the job market wasn't actually as strong as it previously had looked. It wasn't
right.
that the sky is falling. It was that over the course of the year, about 800,000 less jobs were actually added in the United States than what we had assumed. And if the Fed's making policy all along based off of the old assumption, that's going to change how they're thinking about things when you have a revision of that size. It was a big one, but it is part of kind of a normal process that happens as new data gets revised. So the Fed, I think, looked at things and said, okay, maybe the labor market's foundation, the job growth isn't actually as strong as we thought. It's strong. The unemployment rate's rising, not because people are getting laid off, but because firms are hiring a little bit less aggressively, and labor supply is growing fast. So within all that, it is nuanced. It's certainly, there's arrows pointing in different directions. But the larger story that still holds, and for the optimists among us, which I would put myself in that camp for years, through 2 or 3 years now, as others have been, recession's always around the corner. People pushing back on that, like myself, it's always been, hey, look at the labor market. If people aren't getting laid off, they're not losing their incomes, then you can't tell me that there's going to be a big downturn. That's, of course, there's shocks and there's black swan events, but a downturn can only be so painful and so protracted if people aren't losing their jobs and losing their incomes. And that still isn't happening now. So the Fed's taking it. They talk about the balance of risks between inflation and the job market. Those things have come into balance. It doesn't necessarily mean that they're panicked about the job market as much as they're sanguine about inflation. So those two things have come into better balance, and I think explain most of the Federal Reserve and our point of view about the U.S. economy today.
Let's kind of go back to the investment part of this, right? And so, do you expect with some of this refinancing of debt, that you're speaking of, which sort of seems to be the first order of business for enterprises and for companies that have debt on their balance sheet, what do you expect for them to do with that kind of, freed up capital, freed up money? Do you expect potentially, increased M&A? Do you expect, that to kind of be freed up where that has, that activity has obviously been suppressed for some time? That has other headwinds, of course, too. But I think that the interest rates and debt has been an issue. So M&A, but then also, let's say, technology investments, right? Do we expect them to potentially invest in new infrastructure, AI? Hire? Are they going to hire? Where do we kind of expect, or do you expect to sort of spend some of this freed up capital or money? Or is it just relief alone, and they'll just return it to investors, or say it's freed up and we're happy with that alone?
For one, the investment in technology and infrastructure, those things have been pretty strong. And I think I go back to just earnings season most recently. Some of the justification you heard business leaders put out was, hey, yes, there is this massive part of our business right now, where we're investing in AI and all these new technologies, and maybe we're having a hard time drawing the line from that to bottom line business performance, or like what is the profitability of this investment isn't super clear now, but we got to get, we can't fall behind is really what the argument has been. So if you take that and say, hey, now lending is investment is cheaper. I don't know that necessarily translates to even more of that. I think the argument that there's been a surge, at least from the big firms that are well capitalized, they'd have the ability to do this. That investment is not lacking, at least in that space. When it comes to M&A and that activity, I think there's a lot of good arguments, especially a lot of private equity firms have a lot of cash on hand. But in our role within Moody's, we're not privy to a lot of kind of the specifics there, nor are we kind of allowed to talk about too much there. So I don't know if this is an editing opportunity or not. But the So I think the environment I can speak more to the environment of why things might become cheaper. It's cheaper, debt financing and acquisition, but not something we typically discuss all that much. Justin,
I would say, just to build off Matt's point on the strength of investment over the last couple of years, and this will kind of go back to my area of focus, there's been a certain sense in which expansionary fiscal policy has allowed for some offsetting of the effects of monetary policy. So you think of things like the Infrastructure Investment and Jobs Act, which really pushed a lot of money into the construction sector, especially for infrastructure, highways, rail, roads, things like that. And on the other side, you've seen manufacturing construction explode over the last 2 years or so with the passing of the CHIPS Act. So there's a real impetus in the United States right now to compete in the semiconductor build out with kind of reshore a lot of that for national security purposes, and it's resulted in a lot of large firms that, getting opportunities to take subsidies from the federal government to build out their semiconductor production on a local and domestic level here in the United States. So, and then that has translated into some of the national accounts. You look at, private fixed investment that's non-residential. You look at equipment investment and software investments. Companies have still been investing. That being said, looser monetary policy will almost certainly allow for that to continue, even as expansionary fiscal policy becomes less of a support. But it'll probably look similar to, kind of what it's been the last couple of years, where you get this kind of healthy moving forward of investment.
Right. Let's talk, what about the consumer side of the equation, right? We've talked a lot about business spending and business investment. And, I think a lot of the news stories that I've read, and I, as the director of PR, I read the news religiously every day. I think the indicators have been that consumer spending has been pretty damn strong throughout this process, right? And throughout even inflation, the highest inflation. And so what does the rate cut mean for the consumer side of the equation? Does it mean nothing? Does it mean something? Curious.
This is a great discussion, especially leading up to this. Hey, this cut's coming. What does it mean?
Yeah.
Because a credit card, if you locked in a fixed mortgage rate, yes, September's meeting is not going to change the interest rate that you are charged or for your mortgage. But adjustable short-term debt like credit cards, okay, that will digest lower interest rates relatively quickly. So what does it mean if your credit card company is going to charge you 23.75 instead of 24.25 APR? Probably not much. That's a marginal effect on consumer spending, moving in the right direction, but not the kind of thing that moves the needle. So that, I think, shouldn't be overstated, the effect there. I do think that mortgage rates continue to see, mortgage lenders look at the Fed, they see what's going on in bond markets, and mortgage rates are coming in. And they've come in already faster than, and not just from September's meeting, but over the past, really since July's really weak jobs report, bond yields have come down, mortgage rates have come down faster than we thought that they would. So there's already an uptick in refinancing. And what does that mean? If you're an unwise person like myself that bought a house in 2023 at a high mortgage rate, like it doesn't take much more for it to be a really like valid time for me to go and refinance, and that's a lower monthly bill, and that's more in our budget that we can spend on other stuff. So there's a boost to consumer spending on the refi side, but most people locked in 3%. They're not me, and they don't actually they're not evaluating mortgage rates as a potential refinancing.
But it sounds marginal. It's not. It sounds marginal.
It certainly is
on that side directly. It sounds to me like what would be on the consumer side would be more, and dare I use an economic term that's probably controversial, more of a trickle down effect from the business side that would come to consumers, from investment in certain things or M&A or something of that effect. Would that be accurate?
I think so too. I mean, I think that's less direct for the way we typically think about consumer spending. But if businesses are expanding and hiring, that's income growth. That's more spending. And then harder to quantify is the psychological effect. 2 years, very consistently, everybody has said how pessimistic they are. Look at every survey, sentiment survey, downbeat, bad. And what's been the reason? I hate inflation. Okay, well now inflation's still here. Price levels are still up. But by the Fed's account, it's no longer something that they're concerned about in clear terms. It seems, at least it's not. It's diminished considerably as a concern. So, if you don't have that to point to anymore, are people going to start feeling better? We've long cared about sentiment surveys because they dictate the way people behave, businesses spend, invest, hire. So, is there any psychological effect there? I talk to other economists that I respect a ton that are usually more right than I am, and they think, no, that's a silly thing to really focus on. And that's probably the case, but
that's because they're smart and they look at this stuff every day. I mean, how much the psychology behind this stuff is interesting, right? I mean, I look at the three of us, we're relatively young. We all grew up in an era of low interest rates, right? For most of our lives, most of our adult lives, rather. Our parents probably didn't, right?
Yeah, I think that's a great point. Interest, how are mortgage rates above 4% is a very generational observation.
Yeah.
Because, likely our parents thought that was impossible when they were getting 10% mortgages. Or
yeah,
higher.
exactly.
So, yeah, it's a great point. So maybe we will start to see a shift upwards as interest rates come down in mood.
Yeah, exactly. No, go ahead, Justin.
I will add to that too. It's like, if you look at consumer sentiment surveys, specifically the conference board surveys, I tend to like that one a little bit better than like University of Michigan, for instance. If you look at those surveys, there's a really interesting disconnect between the two main components, the present conditions index and the expectations index. If you look at the present conditions index, it's actually pretty strong historically. You can compare it to previous expansions and maybe it's a little bit weaker, but altogether it's doing okay. And people have a more or less favorable view of the economy as it stands. Now, this is going to vary across the income distribution. So lower income households tend to be a little bit more pessimistic on where we're at. They spend a disproportionate share of their income on, your typical consumer goods, groceries, gas, things like that. But if you kind of dig into the components, it's the expectations index that is really weighing on sentiment and looks like it's kind of at levels that are consistent with previous recessions. And I think this gets to the psychology story, is that people look at, okay, I have a job and my wages are outpacing inflation. Okay, that feels good. The stock market's doing great and my house is worth more than it was 4 or 5 years ago. So you have these wealth effects that are really boosting people's confidence. But interest rates are high, and what if inflation reaccelerates or prices never come down? What if I lose my job because interest rates are too restrictive? Things like that. And then you add the election on top of this and all the uncertainty that comes along with that. And people are just really anxious. So there's certainly a huge psychological component. And maybe that's some carryover from the pandemic, because it was just such a crazy period of record unemployment and job loss and GDP contraction. So there's a ton of things that came out of that. And then, of course, the inflation that came just a year or two later. And so there's probably some carryover from the pandemic. But I think, interest rates, inflation have made people think, well, if that happened before, what if it can happen again?
Those are phenomenal points. I think the the point that you made about the difference between kind of where people are today with the sentiment and kind of the fact that it's their future prospects that they're concerned about, and that's kind of weighing things down, and that it's a lot of it is probably rooted in an anxiety, and that anxiety comes from experiencing a black swan event, right? And relatively recently for many of these folks. It's like, okay, well, it's really great to see unemployment where it is, but oh boy, that could change at any moment in time. We know when we saw that March 2020, April 2020 shoot up because it was, a black swan event. And so I think we have, we could probably all agree that there's two candidates that most of the electorate didn't want. That through polls saying, that's not necessarily that most of the American voters wanted as the two candidates. And so it's that alone is sort of an uncertain future for America. And so it is an interesting time, right? And that weighs on the economy, and a lot on Jerome Powell's shoulders.
Sure.
That poor man. But since we got on that topic, I wonder if we turn to the election for a moment. It's September. We're getting into this, we're in the second half of September right now, and we're in absolute full swing on the presidential election as we speak. We'd love to get your perspective on how this election is influencing the economy, which is a very interesting economy at the moment, as we've described, and how consumer sentiment is different than business sentiment and those types of things. So how is it influencing the economy, and going back to kind of business decisions and the, sort of business executives?
Well, I think that probably the primary economic metrics that's picking up the effects of the election is probably the sentiment surveys, thinking, the one we just talked about, the Conference Board measure, also the NFIB survey of small businesses, also some CEO surveys. And across the board, the election is just regularly cited as something that is just increasing the level of uncertainty in the economy. Now, that being said, surveys have suggested that CEOs have been a little bit more hesitant to make large capital investment decisions until after the election. There's almost certainly going to be certain policy shifts, after November, with Congress having to decide the budget, but then also the potential for a new candidate. Now, if in the event that Kamala Harris wins the election and she has to work with a divided Congress, which seems to be the most likely scenario, there's probably just going to be a lot of gridlock and not a lot of major policy change. But there is certain things that have to be taken care of, such as the debt limit suspension expires January 1st. That has to be either extended, suspended, or done away with, so that the U.S. federal government does not default on any of its financial obligations. That will almost certainly have to be ironed out early on in the new congressional term. And then at the end of 2025, two major legislative, or I'll say pieces of legislation expire, namely the personal income provisions of the Tax Cuts and Jobs Act in 2017, which was kind of Trump's landmark piece of legislation. There's also some business tax cuts that expire at the end of the year. And then there's some premium subsidies for ACA-related health insurance that are going to expire at the end of the year. So Congress has to get to work, kind of no matter who's president or who's in control of the legislature. But I think a lot of businesses are looking at this and saying, there is potential for some significant policy change, depending on the election. And right now it kind of looks like a toss-up. So I think a lot of CEOs and small businesses, mid-sized business, really kind of across the size spectrum for private enterprise, it looks like a lot of them are just saying, we'll reevaluate after the election on what our plans are for the next 6 to 12 months.
Take the toss-up sort of issue, and combine that with, I'm going to get a little wonky for a second, with how both Harris and Trump might wield their executive power differently, right? I think that might be an interesting look at from the business leader's perspective, because either from what they've said on the campaign trail or from what they've done in office. And right, Harris is only vice president, so she doesn't necessarily have the executive power of president. But just in terms of when there is gridlock in Congress, the chief executive often uses what they can within the executive branch to enact whatever policy they want or what they're looking for. And so I think that is an interesting aspect of this election. Would you agree? And what do you think? How do you think a Trump administration or a Harris administration might use that sort of executive branch differently in terms of policy?
Well, I think that Trump will primarily focus on foreign policy issues from the executive to make policy decisions, and Harris will probably focus more on deploying executive agencies such as maybe the SEC or the FTC for certain kind of antitrust or other regulatory action. So on to focus on Trump real quick, he will almost have unilateral authority to levy tariffs on imports from any nation which he chooses. So he's proposed a 10% universal across the board tariff on imports, potentially higher tariffs on China. So businesses have to think about what that might mean, whether it be from, if they source their input goods from certain nations that get hit with a tariff, or if they're affected by retaliation or movement in the dollar, if they with the addition of tariffs. So that's something that should be on their minds. And on Harris's side, there's been some ambivalence with proposals. A lot of her proposals have focused on tax credits for lower and middle income households and an expansion of new home development. But I think, given her record, there will probably be a use of executive agencies to really expand certain labor laws. So the Biden administration has done a lot of that with protecting workers from heat, expanding the amount of people who qualify for higher overtime pay. So we can probably think about seeing things like that. And then maybe there's some downside risk to mergers and acquisitions where she deploys the DOJ and the FTC and the like to enforce antitrust laws in a more stricter way.
Yeah, no, that makes sense. Something that we're keenly watching and interested in here at West Monroe is certainly AI, but AI's impact on energy policy and energy load on the grid for utilities, and how that is changing, whether it's just sustainability commitments or infrastructure or even investment in clean energy and those types of things. And so I think it's going to be really interesting to watch energy policy heading into 2025 as the result from the election as it relates to AI, because AI is such a strong point for the United States in terms of advancement, and it's but yet it poses a challenge, right, for energy usage. And do we need that diversification? Do we need just more clean energy, right? There seems to be a healthy debate across many industries right now, and quite frankly, many industries that West Monroe serves. But it needs to be figured out pretty quickly, and in a lot of industries that don't move very quickly. And unfortunately, there's not a lot of policy debate in these debates, and so it's hard to get to an answer on what different administrations would do. How much are you or Moody's sort of paying attention to that trend that's going on?
Well, I will say energy is not my main focus, so I can't speak too much on this topic. But I mean, there's certainly a sense in which Trump has really emphasized regaining American energy independence. There's an interesting nuance to that. policy proposal, if you want to call it that, because of course the U.S. is producing at almost record high rates right now. Now you can have an argument of whether the U.S. would be producing more if Trump allowed for certain federal lands to be open for drilling and things like that. But I think your assessment's generally correct. AI and semiconductor production and kind of the those data warehouses that house a lot of this stuff, it does suck up a lot of energy. And so, I think there's a good question to think about what is, how sustainable is that? Can the U.S. produce enough energy to, reasonably serve households and businesses in a normal way? And then plus the demands from AI, I think that's a very good question. And it's something that, probably we should think about a little bit more, although I'm sure someone at Moody's is doing that.
Yeah, no, for sure. Well, and I know we're getting close on time. I want to ask you each one question, a sort of broader question, which is, what are your predictions for the rest of the year and heading into 2025? Matt, do you want to start?
I was going to say, if Justin, you start, I'm just going to take the exact opposite of whatever you say. I have a pretty consistent view. The labor market is tight because boomers are retiring. That's not a short-term trend. The unemployment rate was 3.3, 3.4 not so long ago. I think that's more than full, over full employment. So I think the labor market did need to loosen, but we are entering an era of a structurally tight labor markets. That means strong income growth. I think people are going to be in demand, even with productivity enhancing technology all around us. I think those things take a long time to filter their way through. Adaptation takes a long time. So I'm not somebody that thinks that AI is putting everybody out of work in the next 18 months. If you look at the computer revolution, it was the long story, like, hey, computers are everywhere except for productivity statistics. It took a long time for that to happen, but nobody denies that it was productivity enhancing. I think AI will be of similar scale, but it'll take a little while. So for the time being, tight labor market, people making good income, spending, pushing the U.S. economy forward at a pace that is the envy of the rest of the rich world. So I remain optimistic. Policy, I think will be loosened more quickly than probably not markets. Markets are dovish, but I think the risks are for a more abrupt loosening in policy with inflation receding, because I don't see it turning around. There's no reasons that I see for inflation to reaccelerate. So interest rates come down quickly, puts the housing market in better balance. Investment keeps rolling along as it had been, but without the help of fiscal policy, just easier financial conditions.
So consumers should be much less anxious, according to Matt.
I've been saying that for years, that there is stop checking under your bed for the recession. But maybe that's awesome. My personality.
Justin, what about you?
I think my views are largely similar. Expect the economy to grow at about potential pace, about 2%, over the next year or so. Expect loosening of monetary policy, probably more restrictive fiscal policy. So don't expect a lot of support from that side of the economy. But employers will probably still add to payrolls at a, slower pace than they have over the last couple of years, but still, healthy enough to maintain, solid growth in the labor market from a historical perspective. And unemployment should remain, somewhere around 4%. We shouldn't expect any market increase in unemployment. Again, just kind of reiterating Matt's point, we really shouldn't expect any meaningful economic deterioration unless there's some unforeseen shock that hits the economy. That being said, there are some downside risks that I think need to be paid attention to. Probably the most imminent is potential government shutdown. That the Congress is coming up on the clock right now of passing either a continuing resolution, which is a temporary funding measure to fill in the gap until they can get together a full year budget, or maybe they could just pass a full year budget. That seems very unlikely by September 30th. And so, just as a general rule of thumb, the a government shutdown shaves about 0.1 to 0.2 percentage points off annualized real GDP growth for every week that it extends. So a prolonged shutdown could meaningfully eat into the economy. So that's one of those maybe shocks that could be paid attention to. And then geopolitically, of course, there's risk of spread of war in the Middle East. That'll primarily be seen through oil prices. If there's a spillover in regional war and a market increase in oil prices could hit the U.S. economy in a negative way. And then, of course, the debt limit breach that would really, if that occurs after the debt limit expires at the beginning of the year, such that the U.S. government either pushes the wire and like they did last time and not vote to extend or suspend the debt limit until the 11th hour, I think that investors should reasonably be pretty anxious about that. And if there is an actual breach, we can expect, especially bond markets, to be rattled a lot. So those are just some those I guess are pretty negative downside risks. I guess you could say AI is an upside risk, things like that. A faster monetary policy loosening is an upside risk. But I do think that those are something that especially businesses can pay close attention to over the next year.
All right. Wonderful. Well, thank you both so much for your time today. I hope you enjoyed the discussion. I hope everybody learned something as well. And we really appreciate you coming on our podcast.
Thanks for having us.
Terrific. Thank you.
Thanks, Matt and Justin.
Thanks for listening to This is Digital. If you enjoyed today's show, please follow or subscribe on your preferred podcast app. And don't forget to leave us a review. For more information on This is Digital, visit westmonroe.com/thisisdigital.